Wow. Very good numbers indeed. I wonder what the intrinsic value will end up being. Hello and welcome to a new stock analysis video. Today's objective is to decide whether Adobe is worth a deeper dive or if we should discard it as value investors. We will quickly analyze the stock using the discounted cash flow method. Are you ready? You might ask, why Adobe? Based on the previous analysis, it's close to being fairly valued and the stock has been going down for a year and a half. So, it could be an interesting stock to analyze again. This is the previous analysis done in April. I've prepared a blank DCF template, the income statement, the balance sheet, and the cash flow statement from Ticker Terminal. I have the ratios and future free cash flows ready on my second screen, which we will input into our template after. Let's start by transferring some of the data from our previous analysis. Copy and paste the name of the company, the stock exchange, and the ticker. We're going to use our past records of intrinsic value calculations to see how they might have evolved through time. Don't forget to prepare a new row for today's analysis and leave it blank to use after. Okay, let's crack on and start with the first element of the checklist, the revenue. I'll go to the income statement and copy the revenue and the net income at the same time. So, let's insert a chart that helps us visualize better the evolution of the revenue. Very nice to see revenue has been growing nice and steadily between 14% and 18% in the last 5 years and 9 years respectively. And it seems that based on the trailing 12 months, it's going to be a good number for the next year as well. So, I'm going to put it as a yes in our first check. Now, let's do the same for the net income, which measures the profitability of the company. Overall, a growing net income with bigger growth during COVID and a bit flat after. Still, good net income growth rates. So, I'm going to put it as a yes. Let's jump into the shares outstanding. Copy the data and paste it on to the shares area. Not only they are buying back an average of 1% of shares each year, but also good to see Adobe is steadily buying back shares throughout the years and not just a one-time thing. Let's see how the graph looks. Very good sign regarding share buybacks. So, let's move into the PE ratios and into the price to cash flow ratio. What we can see is, regarding the PE ratio, it's around 21. So it's not below 20, but I'm going to put it as an in-between. It's neither good nor bad. Move to the balance sheet and copy the cash equivalents and the short-term investments that we can see here. Then, I'm going to copy the total debt that the company has. As you can see, we have a negative net cash, meaning the total assets are lower than the total debt. So we would have to discount a little bit from the intrinsic value resulted. The last sheet copied from Ticker Terminal would be the cash flow statement. In one go I will copy the cash from operations, the capital expenditure, and the free cash flow. Better to view it as a chart. Again, we have healthy growth levels of free cash flow, between 14% and 22%. So it's going to be a green light here. Now that we have the free cash flows, the price to cash flow is automatically calculated in this cell. It is the result of dividing the last free cash flow by the market cap. It's under 20, so it's going to be a go in the checklist. Similarly, we are going to calculate the debt payoff period by dividing the total debt by the last cash flow. If they dedicated the full amount of free cash flow of last year's free cash flow for the debt, they would pay it in 0.84 years. It's obviously under 3 years, so that's a good sign. Now we're going to move into the ratios. I'm on my second screen, but you can do it yourselves and you can go into the ratio section of the Ticker Terminal site. The current ratio is 1.02, so it's just above 1. So I'm going to give it a yes. In terms of debt to equity, it's 56%. Again, it's not perfect, but I'm going to give it as a middle ground quality check. With a 46% return on invested capital, we can say it's a very good result. We want it above 9% since it is the average the S&P 500 has returned historically. It means the company knows where to invest rather than just the possibility of leaving it in the S&P 500. I'm not going to fill in the 3 last checks since I only go through them in case of being candidates for further research. What do we have then in terms of future free cash flow? Move to the estimates in the Ticker Terminal platform. We're going to paste it below and manually insert the values. I could have a new sheet as previously done, but I prefer it this way. Remember, I'm putting them in billions. Always careful with units. Based on analysts' future free cash flows, we have a 13% CAGR. In the past, it has been between 14% and 22%. Now, what growth rates do we want to use here for our best case, normal case, and worst case scenarios? Well, it depends on you, but I like to be more conservative. I will assume a 15% growth rate. and for the sixth year assume a slower growth of 10%. Following the same logic, I will set a 10% growth rate for the normal case. And last, in the worst case scenario, I will still assume growth but lowering it to 5%. Do you believe they are realistic growths? Leave your thoughts on the comments. What is my final verdict about Adobe stock then? Based on assumptions presented today, we come up with an index ratio of 1.05. Our fair price for the stock would be $364. Value investing goes beyond simply calculating intrinsic value with a discounted cash flow model. It also requires considering the margin of safety and the risk-to-reward ratio. In this case, the margin of safety for the stock is essentially non-existent. I see a primary risk for Adobe tied to the rapid advancement of artificial intelligence. As AI tools become more capable in fields like design, video generation, and content creation, it could become increasingly difficult for Adobe to maintain its competitive advantage. While I believe Adobe is a very good company and is currently fairly valued, its lack of a margin of safety combined with the potential for AI to negatively impact its free cash flow makes it a less attractive investment. When it comes to a fit in my portfolio, I'm already invested in other software-as-a-service companies, which makes me less interested in this one. Lastly, now that I have finalized my thoughts, I like to check out other investors' videos. Beware! It's not about just copying their numbers. Jimmy, from Learn to Invest, valued the stock at $447 earlier this year, much higher than my fair price. And that is all for today. Hope you enjoyed the video and have encouraged to start your own process and template. Please like the video and subscribe for more.